A breaker block is a former order block that fails, then flips its role and becomes a high-probability entry zone in the opposite direction. Breaker block is a level institution used to re-enter, mitigate positions, or continue the new trend. In this video, we're going to talk about breaker blocks, what they are, why they work, how to identify valid breaker blocks, and how to apply them effectively in your trading using real chart examples. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. A breaker block is a previously valid order block that fails and then transforms into a powerful supply or demand zone on the price chart. This shift occurs when price breaks through an order block in the opposite direction, causing that level to flip its role. We know whenever price breaks through a resistance level it becomes support. Similarly, whenever the price breaks through a support level it becomes a resistance level. The same logic applies to order blocks, but with greater significance because order blocks represent areas of institutional activity rather than simple retail support and resistance. When price decisively breaks through a bullish order block and closes below it, that demand zone loses its strength and becomes a supply area. This newly formed supply zone is called a bearish breaker block, and it is an area where price is likely to face rejection upon a retest. Conversely, when price breaks through a bearish order block and closes above it, that supply zone flips into a demand area. This is known as a bullish breaker block, where price has a high probability of reacting on a revisit. Now let's see what is the psychology behind the breaker block and how it works. Consider a bullish scenario where a bullish order block forms after a clear break of structure. Traders identify this zone as a buying opportunity, and long positions are executed when price returns to the order block. However, if price makes a change of character by breaking and closing below the most recent swing low, the bullish bias is invalidated and the market turns bearish. At this point, the original demand zone loses its bullish purpose and turned into supply zone. Traders who entered by positions from that order block are now trapped. As price moved below the zone, these traders hope for a pullback so they can exit their positions near break-even. When price returns to this area, their buy orders are closed, effectively turning into sell pressure. This sudden release of trapped liquidity fuels strong bearish momentum. At the same time, retail traders interpret the market structure shift as a confirmed bearish breakout. They wait for price to retrace so they can enter short positions from what they see as a retest of the broken level. These actions of trapped buyers and retail sellers at the same zone transforms the failed order block into a well-defined supply area. This is why breaker blocks often produce sharp, clean reactions and high-probability reversals. Now let's proceed to the next topic and see how to identify a breaker block. To identify a valid breaker blocks we need to consider several criteria and rules to use them to our advantage. The first condition is liquidity sweep before the market structure shift. In a bullish context, price must sweep liquidity above the most recent swing high before reversing. A candle close above the high is not mandatory for breaker blocks, but liquidity must be clearly taken. In a bearish context, price must sweep liquidity below the recent swing low before reversing. The second condition is that once liquidity is taken, price must start to reverse its movements. The third and most critical rule is confirmation through candle close. In a bullish market, a breaker block is only valid when price breaks and closes below the recent swing low. A simple wick or temporary penetration is not sufficient. The market must show commitment. This turns order block into a breaker block. Similarly, in a bearish market, price must break and close above the recent swing high to confirm a bullish breaker block. Finally, breaker blocks are considered one-time use zones. The highest probability reaction occurs on the first return to the breaker block. Once the zone has been mitigated, its effectiveness is significantly reduced, and it should no longer be treated as a high-probability area of interest in the future. To integrate all the criteria and rules for valid order blocks, let's examine a real chart example. In this example, the market is clearly in a bearish trend, consistently forming lower highs and lower lows. After price breaks below the previous swing low, liquidity resting below that low is swept. Following this liquidity grab, price sharply reverses and moves higher. When a candle breaks and closes above the recent swing high, this confirms a valid market structure shift and validates the formation of a bullish breaker block. Once the breaker block is confirmed, it becomes a key area of interest. When price later retraces back into this breaker block zone, it presents a high probability opportunity to look for long positions. For entries, you can wait for additional confirmation based on your trading style. This could include lower timeframe candlestick patterns, a market structure shift, or other price action confirmations. These confirmations help refine your entry and manage risk more effectively. After price retraces into the breaker block, there is a strong probability that the market will reject this zone and continue moving higher, aligning with the new bullish direction. This is how breaker blocks allow you to trade with market structure and institutional flow rather than reacting emotionally to price movements. That's it, traders. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.